Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my undisclosed off-grid studio with another explication request. The best free supplement to your paid study materials is my YouTube channel, but if you're looking for a paid supplement, I highly recommend a Kaplan QBank. If you're taking your Series 7 with the 15% Guru discount, Guru 15 discount at checkout, that's $55.80 for over 3,000, closer to 4,000 practice questions, performance tracker, ability to create custom quizzes, simulated practice tests. I think it's best in class. For that commercial, Kaplan allows me to give you a free look on Kaplan content like this question. I'll help you with any question, but if it's a Kaplan question, you can just send me the QID backstage. If it's a other test prep vendor, I'll still help you, but you'll have to send me a screenshot. Explication requests can be sent to explicationrequest@guruexamprep.com. All right, well, let's get started on this question. A client enters a buy stop order for 100 shares at 40. I think this is very much spot on in terms of the kind of question you could see. We should definitely know that a buy stop order would be placed above the current market price, right? So we should be able to intuit that the market must be somewhere below that. They tell us that, but I mean, they may not be so kind in other situations. We don't know what this person is doing, but we do know there are three uses of a buy stop order. The three uses of a buy stop order are to stop a loss in a short stock position, to protect a profit in a short stock position. So, A is risk mitigation, and then, B is risk mitigation in terms of protecting the profit. And the final use would be to establish a long stock position if the stock breaks through its resistance. I put this instead of when the 1, 2, 3 format, the ABC format, because whenever there's three of a thing, the kind of format they love on the test is except. All the following except. A lot of people have a buy stop, like we're looking at here, at 40 with the stock at 38, or somewhere around 38. We don't know whether stopping losses or protecting profits or establishing positions, but as the market comes up, these orders get triggered and they add more fuel to the fire. And so buy stops, testable point, can accelerate bullish trends because as the stock comes up and these stops get triggered and they become live market orders, we're adding more fuel to the fire, more buying volume. All right, on to this question again. So trades then occur. So, I used to have, when I was a practitioner, clients watching CNBC. They're watching these trades go by the tape at the bottom of CNBC. And what most people get hung up on is that this is two separate events. I'm telling my broker, if the stock XYZ trades at or through 40, then I want to buy it at the market. Two separate events. This may or may not ever become a live order. If there's no trades at or through 40, what do I mean by at or through 40? There's no way on a number line to go from like 39.90 to 40.05 without going through 40. So if it trades at or through, it's going to become a live order, and then immediate execution, best available price. All right, well, let's look what happens next. So trades then occur. So we're watching CNBC, watching the tape go by. We see a trade at 38. Now, remember, we have followed the convention here. Slobs, sell limits, and buy stops are placed above the current market price, and we did follow that convention here. So our first trade is 38, nothing happens, right? If there's no trades at or through 40, it never becomes a live order. Next trade we see come by on the tape is 39. Again, my contingency, my qualifier has not been met. Remember, my contingency, my qualifier, if this, then that. If it's stock trades at or through, it hasn't traded at or through. 39.90, nothing happens. 40.05, ding, 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 ding. There's no way on a number line to go from 39.90 to 40.05 without trading through 40. It is now a live market order, two separate events. I want immediate execution at the best available price. Now, in the test, 40.05 will be offered to you, and it's the wrong answer, right? They're asking, what do we likely pay? Now, what they mean by likely is in the real world, there might be people ahead of you. But in the testing fantasy land, we can assume it's the next trade. At least when you pass your exams, you get to leave the testing fantasy land. The Series 7 Guru is stuck here permanently. No wonder I'm demented. So that is what we call the trigger. The order has now been triggered or elected, right? The contingency has been met. The contingency may never be met. I mean, if it never trades out or through, it'll never become live. So now this is a live market order. I want immediate execution at the best available price. And so I'm going to buy it. Most likely what I paid for the stock is 40.10. Hope you found that helpful. I think this is a pretty spot on question in terms of what you could expect to see on your Series 7. You might even see this on the SIE perhaps, and you might even see this on the 65. So I'll put it in all those playlists as well. Remember, inch by inch, your exam is a cinch. Yard by yard, your exam is hard. And I'll see you for the next explication request.